What if you could combine the stability of large cap companies with the growth potential of mid caps? Today, we are diving into the HDFC Nifty Large Mid Cap 250 Index Fund to see if this balance is the perfect fit for your investment portfolio. Let us find out in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals more faster and smarter way. Before analyzing this fund, let us first understand what is HDFC Nifty Large Mid Cap 250 Index Fund. So as an NFO, it opens on 28th September 2024 and closes on 4th October 2024. And some of the key features of this fund is that it is an open-ended fund type and it belongs to the category of equity large and mid cap, and it has Nifty Large Mid Cap 250 TRA as its benchmark index. There is no exit load as well as entry load in this fund, and the minimum investment you need to start investing in this fund is just 100 rupees. And the fund managers for this fund are Mr. Nirman S. Morakia and Mr. Arun Agarwal. And according to the riskometer, the risk involved in this fund is very high. And the primary investment objective of this fund is to provide returns to the investors before expenses, which closely correspond to the total returns of the securities as represented by the underlying index, which can be subjected to tracking error as this is a passive fund. Now let us take a look at the index this fund is representing, which is the Nifty Large Mid Cap 250 index. So the Nifty Large Cap Mid Cap 250 reflects the performance of a portfolio of 100 large cap and 150 mid cap companies listed on the NSE, represented throughout the Nifty 100 and Nifty Mid Cap 150 index respectively. So the aggregate weight of the large cap stock and the mid cap stocks is 50% each and are reset on a quarterly basis. And this index can be used for a variety of purposes such as benchmarking, creation of index funds, ETFs, and other structured products. Now let's take a look at the sectors represented under this index, which is the financial services sector, IT sector, capital goods sector, automobile and auto component sector, healthcare sector, oil, gas and consumable fuel sector, FMCG sector, consumer services, power, chemicals, consumer durables, metals and mining, telecommunication, realty, construction materials, services, textiles, media, entertainment and publication in diversified sectors. So these are all the sectors represented under this index, and the highest weightage is given to the financial services by a weightage of 24.52%, and the least weightage is given to the diversified sector by a weightage of 0.24%. Now let's take a look at the top 10 holdings in the index, which are HDFC Bank Limited, Reliance Industries Limited, ICICI Bank Limited, Infosys Limited, ITC Limited, Tata Consultancy Services Limited, Larsen & Toubro Limited, Bharti Airtel Limited, Axis Bank Limited, Suzlon Energy Limited, and the highest weightage is given to the HDFC Bank Limited by 4.43%, which is why it is in the top first position, and the top 10th position is the Suzlon Energy Limited, which has a weightage of 1.18%. Now if you take a look at the index returns as on August 30, 2024 and take a look at the graph and the tabular column, and from its data what we can gather is that in 1 year it has given a return of 44.18%, and in 5 years it has given a return of 25.96%, and since inception it has given a return of 17.05%. So from the graph itself and from the data gathered, we can understand that in short term it has certain dips, but if you compare in the long run, it has comparatively performed better compared to the short run. Now let us explore and analyze the pros and cons in this fund to help us decide if it's the right fit for our investment portfolio. Let's start with the positives. So the number one advantage here is the balanced exposure to large and mid caps, because large caps are typically more stable while mid caps offer higher growth potential. So this combination provides a mix of stability and growth in your investments. Another advantage is a diversification across sectors. With 250 companies from a range of industries, this fund offers diversification across various sectors. This means that your risk is spread out, reducing the chances of a single sector downturn hurting your investment significantly. Another advantage is the market linked returns, because since this fund tracks the Nifty Large Mid Cap 250 index, you get market linked returns. This provides transparency and alignment with market performance, allowing you to benefit directly from India's economic growth. Another final advantage is the potential for higher growth. Mid cap stocks often outperform large cap stocks in bull markets due to their growth potential. So, by including mid caps in the portfolio, this fund offers a higher growth potential compared to purely large cap funds. As we have taken a look at the positives, the pros, advantages, now let's take a look at the cons, which is the disadvantage. So, one of the major potential drawback in this fund is the higher volatility, because on the downside, the inclusion of mid cap also makes this fund more volatile than purely large cap fund. Mid cap stocks can experience sharper price swings, especially in turbulent market conditions. And there is no active management in this, which is also a potential drawback, because this is a passive fund, meaning it simply tracks the Nifty large mid cap 250 index and tries to replicate it. While this might keep the management costs low, it also means there is no active fund manager making strategic decision to protect your investment during market downturn period. Another potential drawback is the average return in market downturn, because in market downturn period, the fund is likely to follow the broader market trend, which can lead to average or even below average returns during periods of economic instability, as there is no active strategy here to mitigate any losses. So you need to consider this. And also another final drawback is the concentration of top sectors, because despite the broader exposure, a significant portion of the fund is likely to be concentrated in the top performing sectors like banking, IT and consumer goods. So if these sectors underperform, it can have a negative impact on the overall returns in your investment portfolio. That is why you need to carefully consider all these factors and see how it will impact your investment portfolio, and then choose to decide to invest in it. So now, what is the final takeaway from our analysis on the HDFC Nifty Large Mid Cap 250 Index Fund? So in conclusion, we can see that it offers a balanced approach for investors who are seeking both stability and growth. However, it comes with higher volatility and is not actively managed, so it may not be suitable for everyone. That's why it's always completely up to the investor to see whether a fund will suit their investment portfolio or not. So before deciding to invest in this fund or any fund, make sure to assess your risk tolerance and your investment goals before deciding. Our personal opinion is this fund might be suitable for an ultra conservative investor who's not willing to take any risk or even willing to invest in an actively managed fund. But even then, if you do want to invest in an index fund, there are other similar index fund in the market that has a lower expense ratio and even a lower tracking error compared to this fund, which you can give a chance to. And Another thing to remember is that if you're an aggressive investor who's willing to take a lot more risk and you want dynamic fund allocation in your funds you invest, or even you want funds that can outperform the market with the returns it can give, then it's better if you go to invest in a actively managed fund which has the potential to deliver higher returns than this fund, and also it can give you dynamic fund allocation. But this fund is an index fund, which means it will only try to replicate the index returns. So also there will be no dynamic fund allocation, because as I have already said, it will only try to replicate the index. That's why it's better if you go for actively managed fund if you want these factors in your investments. And finally, you should consult with your certified financial planner if you do not have the sufficient time or the sufficient knowledge about the market. Then it's best if you consult with a professional, because they will look at the suitability of the investment objective, risk profile, overlap ratio between these two funds, and the allocation, what you need to give to the allocation, and see if it aligns with your investment goal, your time horizon of your investment goals and your risk tolerance, and then suggest you funds that will suit your investment portfolio and craft a financial and investment plan that will suit your unique needs. So it's better if you consult with a professional before deciding to invest as well.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.